market never lies. Men lie, opinions lie, tipsters lie, but the market itself, in its ceaseless motion, always tells the truth, to a trader who is willing to listen. There are rules that strip the mystery away and make the movements predictable, not in the sense of knowing tomorrow's price at today's close, but in the certainty that human nature repeats, that patterns of greed and fear unfold in the same sequence, again and again. Isn't it strange how so few ever truly see that? They prefer the thrill of gambling, the fleeting satisfaction of guessing right, instead of the discipline of studying rules that never change. The first rule is patience. Most men cannot wait. They crave action. They want the market to provide excitement like a roulette wheel, and so they jump in and out with no reason beyond restlessness. But the market does not pay you for impatience. It punishes you for it. The predictable part is this: when the crowd rushes, when the mob can't resist, that is when the wise man waits. Have you ever noticed how easy it is to want a stock after it has already made its big move? That's human nature, and that very nature creates the same repeating chart of boom and collapse year after year. Another rule is that a man must cut losses quickly and let profits run. Simple words, but hardest of all to obey. Why? Because the human mind hates admitting a mistake, but loves flattering itself with a small gain. A trader will take a 1-point profit and boast of his victory, yet he will hold a 5-point loss hoping the tide will turn. But the market does not reward hope, it rewards discipline. The predictability lies here. Most traders will always do the wrong thing in the same way, and if you resolve to do the opposite, you will win. Haven't you found yourself guilty of clinging to a loser longer than you should, all the while promising yourself you'll get out? Tomorrow, if it doesn't improve, trend is another immutable law. The line of least resistance is always the safest course. Prices move in trends, whether upward or downward, and the great profits are made by aligning with that tide and riding it until the signs say the movement has spent itself. The market tells you which way it wants to go, but men prefer to fight it, to pick tops and bottoms, to guess at turning points. They want to be clever rather than rich. That's why most fail. The predictable outcome is that the few who follow the trend make fortunes, and the multitude who buck the tide go broke. Haven't you noticed how every bull market lures in bears who insist it can't go higher, and every bear market finds eager bulls declaring the bottom is in? The tape is your compass, the price action your only trustworthy signal. Tips, news, rumors, all of them are distractions. The rule is to watch the market itself. If you follow the tape with an open mind, it will show you where the money is flowing. But men love stories. They cling to an inside tip from a friend or a newspaper headline, as if those words could bend the market to their will. Yet the market could not care less about their opinions. It moves according to supply and demand, fear and greed, and the balance is written in the prices for all to see. Tell me, when was the last time a tip truly made you money in the long run? The great illusion is that the market is new each day. It isn't. The actors change, the companies change their names, but the play is the same. It is always a struggle between hope and fear, between weak hands and strong, and if you learn to read the signs, you can foresee the outcome. The chart formations, the price reactions, the hesitations and breakouts. They are footprints of the crowd, and the crowd never learns. Haven't you realized how the very panic you feel when prices plunge is the same panic every other man feels, and that this very panic is the reason bottoms are always oversold? The rule that makes trading predictable is that human nature never changes. That is why the market is never truly new. If a stock is advancing, the public rushes in, pushing it higher, and then higher still until the last buyer has bought. Then the decline comes. And in the decline, the same public, unable to stand the pain, sells in despair, throwing away bargains at the very moment strong hands are quietly accumulating. This happens over and over. What could be more predictable than the repetition of human weakness? I have made fortunes by waiting for the right situation, then committing fully when the line of least resistance was clear. I have lost fortunes when I broke my own rules, when I acted on impulse or allowed vanity to take hold. The rules are eternal, but the difficulty lies in obeying them. A man can write them on a card and keep them in his pocket, but unless he has mastered himself, the card is worthless. Do you believe you can master yourself well enough to obey a rule when your own money is at stake, when fear and hope are shouting in your ear? It is not brilliance that brings success in trading. It is not college degrees, or complex theories, or elaborate systems. It is simply the ability to wait, to observe, to recognize the pattern, and to act only when the odds are in your favor. But men will not wait. They would rather be in the market at all times, long or short, chasing shadows. They cannot sit still and watch, though that very waiting is what makes the great profits possible. I have said before, it was never my thinking that made big money for me. It was always my sitting. Tell me, do you think you can sit through the boredom while the crowd grows restless? The law of action and reaction applies in every campaign. A stock that has advanced swiftly must react, and the way it reacts tells you the strength of the movement. A shallow reaction followed by renewed strength is the sign of continued upward motion. A weak recovery after a decline is the sign of further weakness to come. The rules are clear, but they require study, observation, and the courage to act without hesitation when the signal is there. Yet most will hesitate at the critical moment, then chase when the move is already half spent. Haven't you seen it in yourself, that tendency to wait too long for confirmation, only to buy just as the move is ending? Profits are made in the big swings, not in the small fluctuations. The man who scalps for a point here and a point there spends his life working for the bucket shop. The man who sits through the full move, who has the courage to pyramid carefully in a strong trend, he is the one who finds fortune. It is always the big move that pays, and the rules that point to it are always the same. Do you not see that chasing small profits is simply another form of impatience, the very flaw that ruins most traders? Speculation is as old as the hills, and it will never die, because men will never stop gambling. But speculation based on rules, on understanding of human nature, on study of the market itself, that is what makes trading predictable. The public always plays the wrong way at the wrong time, and that very fact provides the opportunity for the man who knows the rules. How many times must the crowd lose before you understand that your advantage lies in doing the opposite of their instincts? When you see a stock breaking out of a long period of inactivity, when volume increases, when the price moves in harmony with the general trend, that is not chance. It is law. The accumulation by strong hands leaves its mark. The distribution before a decline leaves its mark as well. The rules for reading these signs do not change, but the crowd will always insist it is different this time, that some new condition invalidates the old truths. And yet, every cycle proves them wrong. Can you remember how many times you have heard, "This time is different," and how many times it has turned out to be the same? The man who understands that markets move because of people, and people move because of emotions, he can profit. Because emotions do not evolve. The same fear that drove a man to dump his holdings in 1907 drove another man in 1929, and drives another man today. The chart records it with impartial accuracy, and the chart will record it again tomorrow. Isn't it remarkable that the secret of the future lies not in new information, but in the unchanging weakness of human hearts? Rules, not hunches, guide the successful operator. A hunch may be right once, but rules are right always. If you depend on luck, you may win today, but lose tomorrow. If you depend on rules, you can be wrong on a single trade, but right across a lifetime. The predictability is not in any single event, but in the long procession of repeated behaviors that make the same opportunities appear again and again. Would you trust your fortune to luck, when the rules are written plainly in the history of every great movement? The first essential is to recognize the line of least resistance. The second is to act boldly once you have recognized it. The third is to stay out when there is no clear line. Simple, yes, but simplicity is what men cannot stand. They demand complication, complexity, secret systems, as if mystery could produce wealth. The rules are too plain for their taste, so they ignore them, and the market takes their money. Tell me honestly, are you guilty of seeking some hidden formula, when the truth has been before your eyes all along? Patience to wait is harder than courage to act. You may not believe that when you first hear it, because to most men, courage sounds like the greater trial. They imagine that acting boldly, risking money on a trade, plunging into the market with conviction, that is what requires bravery. And yes, there is courage in taking a position, in staking your capital when the tape gives you a signal. But in speculation, I have found, again and again, that the real test of a trader is not the moment of entry, but the long stretch of waiting before it. The majority cannot sit still. They must act, even when the conditions are not ripe, even when the tape is silent, even when the odds are against them. Do you not see in yourself that same nervous itch, that hunger for action simply for action's sake? The market has a rhythm, but it is not a constant drumbeat. It does not provide an opportunity every day nor every week. Sometimes the conditions align perfectly. The line of least resistance is clear. The volume confirms the move. The broader trend is in harmony. In those moments, a man should act with courage, yes. But between those moments, when the picture is uncertain, when prices drift without conviction, when the tape whispers instead of shouting, the wise trader waits. And that waiting, that stillness, is the hardest work of all. Can you honestly say you are content to sit idle, watching the crowd bustle about, while you do nothing? Impatience is the downfall of more traders than bad judgment. They simply cannot stand being out of the market. They want to feel the thrill of action, the illusion of control, the satisfaction of having something on. So they buy when they should not, they sell when they should not, they move in and out like gamblers pulling the lever of a slot machine. The market, however, is not a slot machine. It is a great weighing machine, measuring the balance of supply and demand, and it does not care for the nervous fluttering of men who cannot sit still. Haven't you noticed how often your losses come not from clear signals misread, but from trades you never should have made in the first place? Patience is not passive. It is the most active discipline of all. To sit with your hands in your pockets while your mind studies, while your eyes scan the tape, while your judgment tests and retests the conditions, that is labor of the highest kind. The man who waits is not idle, he is sharpening his weapon. He is storing up strength for the moment when strength will matter. The impatient man, meanwhile, spends his ammunition firing at shadows. When the real enemy appears, he has nothing left. Which man do you think the market rewards? The restless fool who must trade daily, or the patient operator who strikes rarely, but with devastating force? Consider the great bull campaigns. A stock does not announce its rise with a polite invitation. It moves slowly at first under the surface as strong hands accumulate. Then comes the breakout, the shift in volume, the surge through resistance. That is the moment of courage, when a man must act. But the weeks and months before that breakout, those are the domain of patience. A trader who entered too early, trying to guess the move, often exhausts his resources before the true signal appears. He may even grow discouraged and abandon the play altogether, just as the stock begins its real advance. Haven't you, at least once, sold too soon after weeks of waiting, only to watch the very stock climb without you? The crowd never learns this lesson. They measure success in constant activity, as though frequency of trades were the same as quality of trades. They admire the man who boasts of being in and out a dozen times in a week, never realizing that such activity is merely the churn of a restless gambler. They scorn the man who does nothing, who watches, who sits. Yet that silent watcher is the one who strikes gold when the conditions are perfect, while the restless crowd wears itself out chasing every twitch. Tell me, when you look back on your own trading record, do you not find that the best gains came from a few big moves, held with patience, rather than from the dozens of small trades that filled the gaps between? Patience is also what separates speculation from mere gambling. A gambler relies on chance. He must always be in play, because luck may favor him in any moment. A speculator relies on odds. He waits until the odds tilt overwhelmingly in his favor, then commits. If the odds are not present, he does not act, no matter how strong the temptation. That is why patience is harder than courage. Courage is needed only in the instant of decision. Patience is needed day after day, while the heart yearns for action, while the newspapers shout stories, while friends boast of quick profits. Can you resist that pressure? Can you stand apart? Can you wait while the world mocks your inactivity? Even after a trade is taken, patience remains the hardest virtue. Men love to snatch at small profits, as though taking a point or two off the table proves their cleverness. But the real profits are made by sitting through the whole move, letting the trend carry you far beyond what you first imagined. That sitting requires patience of the deepest kind. A man must resist the temptation to grab at crumbs when a feast is in the making. He must hold through reactions, through minor setbacks, through the constant noise that suggests the move is over. And each day he must battle his own nerves, telling him to act when the wisest choice is to sit. Do you think you have the strength to hold a winning position long enough to see it mature? Or will you let impatience rob you of the very fortune you worked for? Patience is the foundation of all the great rules. To cut losses quickly requires patience with yourself, to accept the small pain today rather than cling in hope. To let profits run requires patience with the market, to endure its fluctuations without flinching. To follow the line of least resistance requires patience with the tape, to wait until it reveals itself instead of forcing your opinion upon it. Every rule is built upon waiting for the right moment, the right signal, the right condition. The market rewards no man for haste, but it rewards handsomely the man who waits. Haven't you realized that the market's greatest enemy is not ignorance, but impatience? I have seen fortunes lost because men could not wait a single day longer. They were correct in judgment, correct in analysis, correct in every essential, but they acted too soon. A premature trade is as costly as a wrong one, sometimes more so. The market is like a battlefield where timing is everything. To charge too early, even in the right direction, is to be cut down before the enemy has exposed himself. To wait until the moment of weakness, to strike when the foe is already wavering, that is victory. Yet waiting that long is more than most men can bear. Can you bear it? Can you let the opportunity ripen fully before you act? The truth is simple, but simplicity is intolerable to most. They demand action, complexity, endless motion. They cannot abide the quiet days, the empty hours, the long weeks when nothing must be done. Yet those are the times when the patient trader builds his fortune, not by acting, but by refraining. He hoards his capital, he sharpens his judgment, he keeps his powder dry. Then, when the signal comes, he unleashes with courage and conviction. The public, worn out from its ceaseless churning, is unprepared. And once again the patient man reaps the rewards of waiting while others squandered their strength. Distribution and accumulation always leave footprints. That is a truth as certain as the rising and setting of the sun. Markets are not mysterious forces beyond comprehension. They are mirrors of human behavior, and when great operators buy or sell, they cannot conceal their actions entirely. The footprints appear in the tape, in the volume, in the quiet movements that seem insignificant to the untrained eye. The man who learns to recognize those footprints, who studies them with patience, gains an advantage over the crowd that no rumor, no tip, no guesswork can ever provide. Have you ever wondered why a stock begins to rise long before the public knows the news, or why it weakens quietly before disaster is announced? Accumulation is the patient work of strong hands. It never announces itself with fanfare. It is done in silence over days, weeks, even months. The tape may look dull, the price may drift within a narrow range, but beneath that quiet surface, steady buying absorbs the stock that weak holders throw away. The strong hands never rush. They know haste would betray them. They buy carefully, in small quantities, never bidding the price up too far, content to wait until their store is full. To the crowd, this period seems lifeless, boring, unworthy of attention. But to the observant trader, the footprints are there, the persistent support on declines, the refusal of the stock to break down, the slight but steady increase in volume at certain levels. Haven't you noticed how some stocks simply will not go down, no matter how the general market weakens? Distribution is the opposite, but it follows the same law. When the insiders, the strong hands, have already enjoyed the advance, they must sell. But they cannot dump their holdings all at once. They must distribute, and distribution requires the eager participation of the public. So they sell into strength, feeding the stock to the very crowd that sees the recent rise and believes it will continue forever. Prices may even climb higher during distribution, for demand is abundant, but the footprints remain. Volume increases, the stock rises more slowly, reactions become sharper, rallies weaker. The strong hands quietly exit, and the public takes their place. Soon after, with no more support beneath, the stock collapses. Isn't it remarkable how the very moments of greatest optimism are often the final stages of distribution? The footprints of accumulation and distribution are written in the action of price and volume. They are subtle, but they repeat endlessly. Accumulation shows itself in a base, a level of support that holds again and again. Each time the stock dips, buyers appear. Each rally may seem unimportant, but taken together, they form a pattern of strength. Distribution shows itself in topping formations, in wild swings, in erratic moves that confuse the crowd. The same pattern recurs in every era, because the process is governed not by chance, but by necessity. Large operators must buy gradually to avoid lifting prices, and must sell gradually to avoid crushing them. The footprints are as natural as the tracks of animals in the snow. Do you think you can learn to see them before the rest of the crowd? Most traders ignore these signs. They crave excitement, they chase news, they act on hunches. They do not study the quiet periods when the real work is being done. They buy after the accumulation is complete, when the stock has already moved far. They sell after the distribution is complete, when the stock has already collapsed. And they wonder why they are always late, why fortune eludes them. The answer is simple: they look at the surface, while the successful operator looks beneath. Haven't you noticed how often you yourself felt the urge to buy only when the move was obvious, or to sell only when the decline was already in full swing? The footprints are not perfect signals, but they are consistent guides. A stock that refuses to go lower during market weakness is being accumulated. A stock that rises on small volume but falls heavily on large volume is being distributed. A stock that builds a wide base, holding firm at the bottom of a long decline, is preparing for a new advance. A stock that stalls at the top after a steep rise, fluctuating violently, is preparing for a decline. These are laws, not guesses. The tape records them faithfully, but only the disciplined eye can recognize them. Do you believe you have trained your eye to read such signs, or do you still allow yourself to be blinded by the daily noise? The reason these footprints matter is because markets are ruled by supply and demand, and accumulation and distribution are the very processes that determine supply and demand. When stock is absorbed by strong hands, available supply dwindles. When demand comes later, prices must rise sharply because little stock remains to be bought. When stock is fed to the public during distribution, available supply grows heavy. When demand weakens, prices must fall sharply because too much stock is in weak hands. This is the mechanism that makes booms and busts inevitable. And because the mechanism never changes, the footprints never change. Haven't you seen this cycle play out in every market you've ever studied? The footprints also reveal the psychology of the crowd. In accumulation, fear dominates. The public has lost interest. They have sold in despair after a decline. Prices drift, volume shrinks, and the crowd assumes the stock is dead. That is when the strong hands accumulate, taking advantage of the public's fear. In distribution, greed dominates. The public sees only rising prices. They rush in to buy, convinced the rise will never end. That is when the strong hands sell, feeding the public's greed. Fear and greed, the eternal drivers, are always behind the footprints. Can you honestly say you have not been caught yourself in that cycle of fear at bottoms and greed at tops? Learning to read these footprints requires patience, because they reveal themselves slowly. Accumulation does not happen in a day, nor does distribution. A trader must watch, study, and compare. He must note how the stock behaves relative to the general market. He must observe the character of the rallies and the reactions. Most important, he must resist the temptation to act until the evidence is clear. That is why few succeed in this art, Because it demands waiting, discipline, and study, virtues the crowd cannot endure. Will you cultivate those virtues, or will you chase every fleeting move that promises quick excitement? There are no secrets in the market. There are only signs plain for all to see, though few take the trouble to understand them. Accumulation and distribution are not mysteries. They are necessities. Big operators must operate in these ways, and their actions leave marks as surely as a footprint in wet sand. The tape is the sand. The footprints are there. You need only the eyes to see them. Isn't it curious how the truth is always before us, yet most prefer to ignore it in favor of tips, stories, and wild guesses? Tips and rumors are poison. The tape tells the truth. That is the rule, plain and absolute, and yet it is the very rule most traders violate every day of their lives. Men are born with a craving for shortcuts, for easy knowledge, for the idea that someone else knows better and will share that secret with them. They are forever seeking inside information, whispers in corridors, gossip from brokers, predictions from self-proclaimed experts. They mistake talk for truth. They forget that the market does not answer to tips. It answers only to the law of supply and demand, which is written in the tape for any man willing to read it. Haven't you seen how the moment you act on a tip, the market almost always proves it false? A tip is nothing more than another man's opinion, usually second-hand, often tainted with self-interest. The man who whispers it may already be selling while you are buying, or buying while you are selling. He is feeding you his opinion to serve his purpose, while the tape records the actual transactions of every buyer and seller in the market. Which do you think is the safer guide? The idle talk of one man, or the collective record of millions of shares changing hands in real time? Yet most traders would rather cling to the comfort of a story than the discipline of studying the tape. Doesn't it strike you as strange that men trust gossip more than they trust the market itself? The poison of tips lies not just in their unreliability, but in what they do to the mind. A trader who relies on tips becomes dependent. He waits for another man to tell him what to do. He loses his judgment, his independence, his ability to think. He stops studying the tape and starts listening for rumors, like a gambler waiting for the next roll of the dice. And when the tip fails, and it always fails, he is not only poorer in capital but weaker in spirit, having surrendered his self-reliance. Do you not feel, when you act on a tip, that nagging doubt in your chest, as though you know already that you are leaning on a rotten crutch? Rumors are even worse, for they spread like wildfire and infect the entire crowd. A rumor may begin with a whisper, but soon it grows into a roar, and before long the whole market believes it. Men buy and sell on nothing but the echo of voices, convincing themselves that if everyone is talking, it must be true. But the tape does not lie. While the crowd chases the rumor, the tape shows the real story, whether the stock is being accumulated, distributed, or ignored. The rumor will tell you what you want to hear. The tape will tell you what is happening. Haven't you noticed how often a rumor sparks a wild move that collapses just as quickly, leaving only losses in its wake? The tape is not a tipster. It is the one faithful witness. Every transaction leaves its trace. Every share bought and sold is recorded. The tape does not flatter. It does not deceive. It does not conceal. It tells you if the market is strong or weak, if demand is genuine or artificial, if prices are moving with conviction or drifting aimlessly. The tape is indifferent to stories. It reflects only facts. The sooner a trader learns to trust the tape and ignore the talk, the sooner he steps out of the crowd and into the class of operators who actually succeed. Wouldn't you rather base your decisions on fact than on hearsay? I have seen fortunes made by those who read the tape correctly, and I have seen fortunes lost by those who followed tips. The man who acts on tips is always late, because by the time the tip reaches him, the insiders have already acted. They bought before he heard the good news, and they are selling to him when he rushes in. They sold before he heard the bad news, and they are buying from him when he panics. The tape shows these actions long before the tip reaches the public. The footprints of accumulation and distribution are there for any man who cares to look. Do you not realize that every time you take a tip, You are entering the market at a disadvantage after the move is already in motion. The danger of tips is also that they feed the vanity of the trader. He likes to feel special, as though he has been given privileged knowledge denied to others. That feeling blinds him to the truth. He does not question the source, he does not check the tape. He simply acts, proud to be in the know. But the market punishes vanity. It cares nothing for how privileged you feel, only for whether you are on the right side of the line of least resistance. The tape will tell you which side that is. The tip will not. Haven't you caught yourself smiling at being handed a secret, only to regret it once the market proved you wrong? Even professionals fall victim to tips. Brokers, bankers, insiders. They are human too, and they love to talk. They enjoy the importance of passing on. Inside, information, and the recipient enjoys the importance of receiving it. But all of this chatter is poison. The market itself is the only insider worth listening to. The tape shows you what the insiders are actually doing, not what they are saying. If they are accumulating, the tape will reveal it. If they are distributing, the tape will reveal it. Their words may deceive you, but their actions cannot.